I've been meeting with a lot of clients of Financial Harvest Wealth Advisors here in the last few weeks, and I've been getting two questions. First of all, David, what happened in 2011? And secondly, what do we need to do because of that? Well, in 2011, we saw that the S&P 500, which represents the U.S. large cap market, was up roughly 2%. Meanwhile, the U.S. small cap, represented by the Russell 2000, was down about 6 or 7 percentage points. The EFI index, was the international large, was down around 12, and the emerging markets category was down around 18%, negative 18. So a big discrepancy in terms of performance. The next question was, well, why don't we move our money or allocate more heavily toward the S&P 500 because of the large outperformance versus a globally diversified portfolio? We then had to reference them back to the late 90s. During that time frame, the S&P 500 was up somewhere between 22 and 40% during those last few years of the 90s. Meanwhile, a globally allocated, strategically allocated portfolio was only up 10 to 15%. It was very tempting to want to allocate more heavily in the S&P 500 to chase those returns. But do you remember what happened after then? In the early 2000s, the S&P 500 subsequently dropped somewhere around 45%. Meanwhile, a globally allocated portfolio stayed the course somewhere even. So that's about a 45% difference, or on $1 million, a $450,000 protection of wealth by staying fully diversified. This is what we call a Callan chart, periodic table. It's probably hard to see, but just focus on one color and follow it all the way across. Each color represents a different market segment. So for instance, the rust orange color is the S&P 500 growth. Notice that in the late 90s, it was one of the top performing asset categories, and then subsequently in the early 2000s is one of the bottom performing categories. Notice that it's random in its nature, meaning we cannot predict in advance what asset category is going to outperform. Which brings you to the second point. Specifically in the last 2 years, if you look at those four categories we already talked about, U.S. large, U.S. small, international large, and emerging markets, what did we see? Well, we saw a total return during that time of the S&P 500 of about 22%. The emerging markets was somewhere around 16%. And U.S. small was up 36% during the last 2 years. Now, how did we get there? This is what I find really fascinating. Just in the last 4 months, from October 3rd to February 3rd, all of the 2-year return for the S&P 500 came in those last 4 months, meaning it was up 22% during that time. All of the return from the U.S. small cap, meaning the Russell 2000, came in those last 4 months. And also the emerging markets and the international large cap were both negative until these last 4 months actually brought it up for a total return that was positive. So what's the second point? Returns come bursty. So what two principles were validated? Number one, stay allocated strategically. It's tempting to want to overweight the category that's been doing best. And then secondly, the returns are bursty. You must stay fully invested. Go through the tough times of roughly, what do we see, 16, 18 months of almost no return, and then here in the last 4 months, 30 plus return in U.S. small as an example. Stay diversified, stay with your strategy. That's the only way you can win and create wealth in the end. Remember, your survival is on the line.